Hello there, Chevron employees. Welcome and thank you so much for joining us here for one of our short but very informative webinars. My name is Sam and I'll be your moderator today. In just a second, we'll be joined by Wesley Boudreau. We're just going to wait for a couple other people to trickle in here. Wesley is going to be speaking to you about some really great NUA strategies you can use if you're hoping to save on your taxes. Before Wesley comes on, though, just a couple quick housekeeping items. First and foremost, please be reminded, we are not Chevron here. We are not affiliated nor endorsed by Chevron. I just have to remind you, we are a completely independent group of financial advisors, so please be advised of that and keep it in mind as you're listening along today. Next, while Wesley's speaking, I'll be entering some links into the chat. They will pop up above his head, and you can click directly on them. They're going to guide you over to our website. You can book a free 15 or 30-minute block of time to get in touch with one of our advisors and speak to them directly about any specific concerns you have or to get started or updated on your retirement planning from Chevron. You can also head on over to our website. You'll find many blog posts we have for Chevron employees and retirees. We really think that that is a great way to keep updated on your retirement and all things happening over at Chevron. We also have a YouTube channel and a LinkedIn channel. You can follow us on both of those. We post a lot of content for Chevron employees, and we really feel you'd get value out of it if you considered giving us a follow on those platforms. And if you do, thank you so much in advance. I truly appreciate it. And without further ado, let's jump right into the presentation with Wesley Boudreau.
All right, Samantha, thank you very much for that introduction. And again, we're going to be talking about NUA for Chevron employees today. Again, my name is Wesley Boudreau, one of the Chevron Focus Advisors here with Retirement Group, now part of Wealth Enhancement Group. And we're going to be digging into net unrealized appreciation. And to be honest with you, most Chevron employees that we work with, retirees, do have access to the advantages of NUA through their ESOP portion of their plan, unless you've traded through it. So we're going to dig into how that plays through the retirement process. We'll talk about some different ideas, give you an example that I put together, and then what to look for. And if you need any additional review of it, feel free to give myself a call or one of the other Chevron focused advisors here. We can go through the information with you one-on-one. So again, a quick regurgitation, if you would, of what NUA is. Again, it's net unrealized appreciation. Very simply put, it's a tax favorable treatment that you have within your Chevron 401k plan that you can actually reduce your taxes versus if you never knew what it was. If you just look at your 401k and assuming most of it's going to be pre-tax and growth, eventually you're going to pay tax on that. Whether you take it from the 401k or move it to an IRA and then take withdrawals, you're paying taxes. Now with NUA, there's an ability for you to actually pay taxes on the cost basis of your Chevron stock, and the growth of it, you're going to actually pay long-term capital gains, which historically and currently and hopefully in the future will always be lower than what ordinary income taxes are. So it could save you, 7-9% or more on your potential taxes. And I'll go through some examples we put together as far as how to review this. And then again, like I said, you can give me a call. We can kind of go through it one-on-one on your situation to see if you do have access to it and then what that process may look like. But again, one of the issues with it is it's an all or nothing situation. So once you go through that, if you want to exercise NUA after a triggering event, which we'll go over in a moment, you have to actually roll over the rest of your 401k to an IRA or liquidate it to yourself, which obviously we're not going to recommend tax-wise. But so typically what's going to happen is you're going to split that up. You're going to roll over your pre-tax and your earnings over to a rollover IRA, and then your NUA is going to go over to a brokerage account, and you're paying taxes on the cost basis. And we'll go through an example to show you that in a moment. So I did mention the triggering events. It's not something you can just do anytime you want. If you're an employee, usually you're not going to be able to do it. There's triggering events you have to pass in order to be eligible to do this. And the key triggering events are going to be separation from service, so termination or separation or retirement. I know a lot of you guys are going through some of the restructuring right now. So again, if you are separating service, then that NUA trigger has been hit. There's another one, reaching age 59 and a half. So you could actually have two separate triggers. You could have one leaving and then one hitting 59 and a half, or you could retire at 62, and both those have already passed. The others are going to be death and disability, so we're going to throw those out the window. Hopefully we're not dealing with that. But so primarily your two triggering events are going to be age 59 and a half and then separation from service. And again, like I said, if you miss one, you may be able to hit the other one, but we'll go over that on a one-on-one basis. As far as the NUA options that you have, like I mentioned, once you do that, you exercise it, you're going to have to roll over the rest of the account. And so you got to be careful about taking withdrawals. If you have gone in there and taken a withdrawal, that also starts the clock ticking as far as having to do NUA by the end of that year. So a quick example, let's assume that maybe I mentioned 2 triggering events. Let's say maybe you retire at 61, so you've already passed 59 and a half, and you've hit that triggering event of separation. And let's say retire in June, for instance, and so you're deciding, hey, I'm not going to take anything, I don't need it, I don't want to do NUA, I'll wait till next year because I had a half a year of employment. But let's say that you call up Fidelity and say in November, early December, tell them, hey, I just need an extra $1,000. Can you send me $1,000? I need to pay for some additional Christmas presents or something like that. Once you've done that, though, that starts that clock, and so now you've got a month or so in order to exercise NUA. Otherwise, if you forgot about that and didn't talk to us, and 2026 rolls around, then all of a sudden now you've missed your opportunity for NUA because, again, you've passed both those triggering events. So be very careful about that. You want to make sure we run through this with an analysis to make sure you avoid some mistakes of that nature. As far as kind of an example, I just put together kind of a quick simple one with simple math here, but it's an idea of what most of you may see in your portfolio. It may be a little bit higher, a little bit less, but in this example, let's take a look at the bottom here. Let's just assume $1 million 401k at Chevron, and let's assume that about $900,000 of that is pre-tax. So that's meaning pre-tax contribution you put in, company contributions, growth, and everything of that nature, and maybe get about $100,000 of a cost basis of after-tax in there. So again, that means you put in $100,000 out of pocket. So that portion is tax-free. It can be rolled over, cashed out, moved to a Roth IRA, or it can be used to pay down NUA taxes. That's your cost basis, but the growth, the earnings, everything else is pre-tax on there. In the same situation, let's assume you got some Chevron stock within that 401k plan, and it may be that you want to exercise NUA on a portion of it. Maybe $200,000 is all of your Chevron stock, or it's just a portion. But in this case, in this example, $200,000 is what you want to exercise it on, with a cost basis of $50,000. So again, that $50,000 is your cost basis. That's what you're going to have to pay ordinary income taxes on the year you exercise NUA. That growth of $150,000, you'll be paying long-term capital gains taxes not until you sell it in the future. So it could be within a week or two, or it could be 10 years, 20 years, 30 years. So again, it's going to depend upon your specific situation. And the longer you wait, the longer the bigger those tax benefits become in some cases. And it all depends upon your specific situation in the year that you're doing this. So let's kind of extrapolate out that example, take that $200,000 we talked about for NUA and use Lucy Norton. This is a name we've used for about 15 years or so in these examples, but let's assume that she is exercising NUA on that Chevron stock, and again, it's a value of $200,000. The cost basis is $50,000, so again, she's got $150,000 of appreciation there, so NUA. And what's going to happen again, she's going to be paying long-term capital gains on that, which is going to either be 0, 15, or 20% depending upon her tax bracket. And then let's assume in this case, she's not looking to exercise and cash out immediately. She's looking to go ahead and hold on to this, and she assumes that it's going to roughly double over the next 10 years. So that 200 grand of Chevron stock is now going to turn into about 400 grand. So let's take a look at kind of hypothetically how this could look and the potential tax savings you could see. Now, we'll preface this. We're looking at this kind of in a vacuum, because we have no idea what Lucy's going to do and when she's going to access that. But let's assume that she is looking at getting at all that $400,000 in that next 10 years or so. So we're going to assume that she's cashing out everything from that, or all that $400,000 from the 401k or IRA, versus if she were cashing out from the NUA. So if we look at that right-hand side, you'll see where tax brackets are right now for 2025. And that $400,000 she's taking out would put her in the 24% tax bracket after we factor in standard deductions. It'll bring her to that top of the 24%. So she's paying 24%, 22, 12, and 10% for different portions of that 401k distribution or IRA distribution. On the left-hand side, we're looking at the long-term capital gains, where she would be paying ordinary income taxes initially on that $50,000, that smaller blue, and then she'll be paying long-term capital gains on the growth that was in the 401k, and then the future growth that's in the brokerage account after. One unique thing to think about is now there's no promises or guarantees this will stay this way forever, but on that example there, that I guess bright green, if you would, that is actually going to be the future growth of that 200,000 growing up to that 400. Now, if she were not to sell this and she were to eventually pass this on to a beneficiary, based upon the tax codes now, she would get a step up in cost basis for that. So that that green, that 200 grand or whatever it may be in the future, would actually be tax free. Now again, there's no guarantees they don't change this tax code in the future, so it is something to be aware of. Let's take a look at kind of how this would actually look in a real life situation, again in a vacuum, and how much she could potentially save. But the potential savings on this case are about $39,000. Again, this is likely not how she would do it. She probably wouldn't be, plowing through the full $400,000 in 1 year. But let's assume she does that. On that right-hand side, we're going to see what we're looking at for her taxes. I'm going to take a zoom in here so you can see it. But on the right-hand side, she's got that. She's married. She's got a standard deduction of about 30 grand, so about 370,000 is going to be taxable. And we go through the different tax brackets, and again, she's filling up those different buckets. But overall, she's paying about 75,000 in taxes. On the left-hand side, she's going to be paying taxes up front on that $50,000, but again, that $30,000 standard deduction is going to bring that down to only $20,000 she's paying taxes on, which will put her in that 10% tax bracket. It's only $2,000 in taxes there. Then in the future, that $350,000 of growth is going to be long-term capital gains, and if we assume she has no other income, then that first tax bracket, the first 12% tax bracket, is going to be tax-free long-term capital gains, that 96 grand. Then she's paying 15% on the difference of that 96 to the 320, so about $35,000 there. So again, that savings is close to $40,000 in this situation. Now again, this is in a vacuum. Likely what would happen is she'd be tapping into some of this over time, so the savings may not be quite as large, but they are still going to be there. Now if you're working with me or one of the other advisors here, what we'll do is we can run a scenario of various NUA calculations for you. You may say, Wesley, I want to look at what's the benefit if I just do this now? I want to get out of Chevron, or I want to put a stop loss on in case something happens to it. If I were to sell immediately or pretty near future, what potential tax savings would we have? So you look at immediate tax savings. In her case, in this example, in that 24% tax bracket, it might come out to only about 13 grand or so. And we can look at the difference of if you're actually going to be paying the taxes out of pocket for NUA, or whether you're utilizing the assets within that 401k to do so as well. If we go back to that example I gave, that person had 100,000 of after-tax cost basis. They could actually use some of that to cover those taxes for NUA. So what would happen is Fidelity would withhold 20% against that. I think in that example we gave, it might have been 35,000 or something like that, or let's say 50,000. And that 50,000, 20% would be 10,000. So what would happen is 10,000 would be withheld from that 100 grand of after tax, giving you 90 grand that can be rolled over to a Roth IRA. 10,000 kind of prepays the taxes on NUA. Now you want to look at maybe kind of Lucy's situation. You want to hold it for 10 years, and it may be that you're saving about 20,000, depending upon how you do it. So not as lucrative as that 39 we showed before, but again, it gives you a better idea. In 20 years, it's going to take a little bit more, about 43,000 or so, if you're paying the NUA outside. If you look at that bottom right, the difference is 32,000. So it shows you that time value of money versus if you were to take the assets out of the account to cover the taxes versus out of pocket to do so as well. So again, everybody's a unique situation. Just give me a call. I'll be happy to kind of run through this with you. And there's this is the first level, if you would. It gets more detailed, and from there we can be more specific on different claiming strategies for that over the course of the coming years as well. So I did put together kind of an example to give you a better idea of what you might see with the Chevron 401k. Now again, this is a real statement that I just kind of squeezed together to make it fit on one page, and obviously adjust the numbers to make them more simple math. But if we look at this, and I'm going to have to zoom in here, I apologize, and I don't think you can see my mouse, so I'll just kind of go through this in order. But if we look at this case, this person's got about $250,000 of Chevron ESOP, that top line, about $300,000 of a common stock. So again, that's what you've put in over time. And if we look down in the post 86, that's your after-tax cost basis. So about $100,000 of that. And they've also got about $50,000 they put into the Roth IRA, Roth 401k. And the ESOP cost basis is 35 grand, and the Chevron common stock cost basis is 200 grand. And then below there, the Roth has that 50's grown to about 180, and the after-tax 100 you put in there has grown to about about 270 or so roughly, if you add those two up. So what we want to figure out is, okay, well, what are the different options for NUA on this? This person, and this is what a lot of you may see if you hold on to a Chevron stock, you're going to have both ESOP and in common assets, or common stock. Typically speaking, the common stock, we don't see people exercising it because, again, a Chevron, unlike ExxonMobil and some others, they do an average cost basis. So as the stock price gets higher and higher, your average cost base is going up, so it's not as lucrative. So in this case, that Chevron stock with that about $300,000 value, cost base about $200,000. Yes, you could do NUA on it, but it's not as lucrative. And if you're going to do $200,000 of taxes now, it's going to cost you a little bit more than what you want to spend probably. So it could be done, but likely you're not going to do that. What you're going to focus on is that ESOP, which is what we see all the time. In this case, you've got $250,000 of stock with only $35,000 of cost basis, so even better than that Lucy Norton example we gave a couple slides ago. So in this case, that's $215,000 of NUA. So you would actually be paying tax on that $35,000, move everything over to a brokerage account, and then when you sell the stock in the future, you're paying long-term capital gains on that $215,000 plus any future growth that you have on there as well. Another thing to remember is that well, if you do that, that $215,000 is built in or embedded, if you would. So even if you went and moved that over and that $250,000 dropped down to $200,000, you're not going to get out of the taxes on there. You're still paying the long-term capital gains on the $215,000. So keep that in mind. Where if it has a pullback, you might want to hold on to it longer, so it makes more sense for you in the long run. That $100,000 of after tax, kind of like the other example I gave you, that can be paid out to you tax-free if you want. I'd argue not to do that if you don't need it. The best bet would be rolling that over to a Roth IRA so it starts to grow tax-free. And that can be combined with the other Roth IRA that you've already got in there. Again, that had a $50,000 cost basis, but it had grown to $180,000. So that growth from that $50,000 to $180,000 within that 401k, because it was Roth money, was all tax-free. The growth from the after-tax, the $100,000 to what I say about $270,000, that was taxable because the growth is not as tax deferred. It's not tax-free there. So you can take that $100,000 plus the $180,000. So now you've got about $280,000 in a Roth IRA from this rollover process. And again, you're going to have to do that because if you want to exercise NUA, you have to roll out the rest of the money. So again, give us a call. We can walk you through all that in your own situation. So the best way to look at this is really kind of putting it together in a financial plan. Right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 5 to 10 minutes with us, maybe 15, depending upon how much information you already have, let us gather that data. We can put together a pretty detailed cash flow analysis for you or a financial plan. Get that back to you in a couple of days, and then we can go from there and tweak it to show you various options, whether it be looking at NUA like we're talking about today, or it could be more detail whether you want to look at how to access the pension plan. Are you looking to annuitize it or take a lump sum? What's the investment philosophy with the 401k? We'll go through all those different options with you. And especially those of you that may have just got recently cut, it may not be that you're retiring, it may be you're mid-career, and you need to find out, okay, well, I was making good money at Chevron, how much do I need to make to survive? In which case you might want to try and focus on a quality job versus quantity of income job going forward for the next couple of years, whatever it may be you have left. So again, just give me a call, we can go through all those items for you. So to kind of wrap up, why the retirement group? Who's the retirement group? Again, we're an independent investment advisory firm that's worked extensively with Chevron employees as well as other Fortune 500 companies. A little bit over a year ago, we actually merged or got acquired by Wealth Enhancement Group, a much larger RIA. So we've got a much wider breadth of services. Over 100 offices across America now, over $100 billion under management. And so if you want to sit down with us face-to-face, we can probably accommodate that, but obviously we can do web meetings, phone calls, email, whatever your preferred communication is. Again, myself and a couple other advisors have focused on Chevron exclusively for the last decade plus. So if you want to dig into your specific plans, don't hesitate to give me a call. We can go through that, whether it be, again, digging into the 401k, the pension, healthcare retiree medical benefits, life insurance continuation, things like that. And ultimately, just take us up on that cash flow analysis. If you haven't done so, definitely give us a call to do that. If it's been over a year or two, give us a call back because things have changed. Interest rates have gone up and the market has changed, so it's definitely a good time to potentially update that as well. And with that, I'm going to wrap this up. I'll give you a couple pieces of information how to contact us, and I've got a couple questions here I'll knock out. If we miss some of them, we'll try and follow back up with you. But any questions, you can give myself or one of the other advisors a call. Again, it's Wesley Boudreau with the Retirement Group. You can give us a call at 800-900-5867. You can also go info@retirementgroup.com and we'll patch you through somebody. You can also use the QR code in order to get into our appointments to schedule a meeting with an advisor. Or we usually have a LinkedIn one on there. If you just ask us, we can get you the LinkedIn information for Chevron, so you stay up to date on all of our Chevron webinars and information from that stuff as well. Okay, first question we got coming in here. If I wait on my NUA, do I have to wait on my pension? This is actually that's actually a pretty decent question. I don't think I've gotten that one before, but I want to be perfectly clear. The pension and the 401k where NUA takes place, those are completely separate. So this person may be thinking about whenever you retire, if you retire before 60, you don't get 100% of your pension plan. There's a 5% age penalty prior to that each year. So I'm going to make this up. Let's say you're retiring at 58. You might say, I want to defer my pension for 2 years, so I get that. So I go from 90% to 100%. Now I'll argue you give us a call so we can look into whether or not that makes sense, because you could also have interest rate changes that could be eroding some of that as well, which we can get into, and it depends upon what your claiming strategy is. But that does not affect NUA. So in that same case, this individual, they may have passed a triggering event by retiring and have access to NUA, but they could defer it until 59.5 or until they defer their pension 60. But you don't have to do one or the other. So you might say, okay, well, I want my 401k to grow. I don't want to do NUA right now, and I'll defer that, but I'll take my pension now. Or vice versa. You may exercise NUA immediately, so you get that over to brokerage account, and maybe you're going to go on and do something else for funding, so you don't need the pension. You might defer the pension till age 60. So there are different options. There are different options that you have within there. Okay. Another quick question is, do I have to pay the taxes up front for NUA? You know what? Yeah. So if it's going to depend. If you've got after-tax money within the 401k, typically there's going to be an automatic tax withholding from that. So in that example, let's go back to the example I gave. I think the 250 and a $35,000 cost basis. So what would happen is, from 401k, there's a 20% withholding. So the 35,000 would be $7,000. So in that example, what would happen is, on that 100 grand, they would take 7,000 out to withhold on the taxes, and then you would actually get that 93,000 that can roll over to a Roth IRA. You might have the alternative. You could actually use the full 35,000 to pay that down. I know a lot of times record keepers will suggest that, but by no means do that. Give me a call. Make sure we walk you through this process, avoiding mistakes. If you do that, you're jeopardizing the opportunity cost of getting that money over to a Roth IRA. Now, if you don't have any after-tax in there, then there's nothing to withhold against. So in reality, you don't have to pay it immediately. So let's assume you had no after-tax whatsoever. In that same example, $35,000, that's going to count as income for the year. Now, if you're doing it towards the end of the year, you can do that when you file your taxes, and you can pay those taxes at that time. Now, if you, let's say, are leaving mid-year or even third quarter or first quarter, the IRS is theoretically going to want you to file quarterly taxes. So you may want to go and double check, okay, how much have I had withheld against my paycheck? Do I normally get a refund, or do I normally have to pay taxes? And if you kind of look at that, if you think that you're going to end up having to owe roughly that same amount on that 35 grand in the example I gave you, then you'd want to go ahead and file a quarterly tax. Otherwise, they can come back and potentially penalize you for that and charge you a little bit of interest. It may not be a lot, but they can still do it. So the answer to that is kind of yes and no, depending upon how your situation is. So hopefully that answers some of these questions here. And again, if you have any more, feel free to reach out to us at 800-900-5867. If you want to dig in deeper with this, you can just ask for Wesley Boudreau, one of the other Chevron-focused advisors. We'll be happy to dig into it with you. And again, even though myself and the others have worked extensively with Chevron for the past 10 plus years, does not mean that we're employed or endorsed by them, but obviously we've got a deep understanding of it. So any questions, just give us a call and be happy and run it by us. Okay? Thank you, and we hope you have a great day.